Welcome to RBC's Markets in Motion podcast, recorded May 20th, 2024. I'm Lori Calvasina, Head of U.S. Equity Strategy for RBC Capital Markets. Three big things you need to know. First, tech has bounced back on performance and earnings revisions, but valuations remain a problem. Second, valuations more broadly for the market have started to look less appealing. And third, other updates in our high-frequency indicators highlight how pendulums have swung on a few different fronts, namely investor sentiment, election stats, and funds flows. If you'd like to hear more, here's another 5 minutes. While you're waiting, a quick reminder that II season is starting soon. If you found our work and podcast helpful, we'd appreciate your vote in the portfolio strategy category. Now the details. Let's start with takeaway number 1. Tech has bounced back on performance and earnings revisions, but valuations remain a problem. Trends in sector performance in the S&P 500 have been fascinating to watch recently. Energy strength has faded, while leadership from utilities, where companies have begun to highlight the boost to power demand from AI, has emerged. Another sector starting to make a move within the S&P 500 lately has been technology. This actually seems deserved from an earnings perspective, as this sector is now one of the strongest in the S&P 500 on the rate of upward revisions to sell-side EPS and sales forecasts again. However, we are sticking with our market weight recommendation on the sector, as valuations do remain quite elevated on our model. Moving to takeaway number 2. Valuations more broadly for the stock market have started to look less appealing, as cuts have gotten baked back into the stock prices again. As we were running through our weekly updates last week, we were struck by how different some of our valuation charts look today than they did a few weeks back. For example, the median forward PE of the top 10 names in terms of market cap ranking within the S&P 500 has rebounded to more than 28 times. A few weeks ago, this stat had gotten down to 25. This is a concerning data point for the mega-cap growth trade, as this level is quite close to past peaks. We also find that valuations have eroded a bit for small caps. The Russell 2000 weighted median PE has moved back up to its own long-term average of about 15 times. A few weeks ago, this stat was sitting well below average levels, closer to 14. Our sense that valuations has lost some appeal for these important pockets of U.S. equities contributes to our ongoing neutral view on the U.S. equity market. Something else in our valuation work is also contributing to this feeling. Our main S&P 500 valuation model, which projects a trailing PE for year-end 2024, based on the relationship between the index's average trailing 4Q PE and inflation and interest rates, alongside consensus forecasts for those macro variables. That model's been telling us that 5,100 to 5,300 is fair value for the index at the end of this year, if we see PCE moderate to about 2.5%, get 2 Fed cuts, and see 10-year yields return to around 4%. Broader market valuations seem fair if the consensus forecast for a couple of cuts, in other words, pans out. Wrapping up with takeaway number 3. What else jumps out on our high-frequency indicators? The image of a pendulum that swung all the way back to where it was to start the year, reversing where it's been recently rather quickly, comes to mind for many of these. We've been on the road speaking with investors consistently over the past few months, and our conversations suggest that the pivot in the S&P 500 stock price action has been driven by renewed optimism about the likelihood of getting Fed cuts in the second half of 2024. This has all been driven by Fed commentary, softer labor data, and evidence of consumer pushback on high prices. We have been struck by the speed and distance with which Fed expectations have swung like yet another pendulum over the last few months. The certainty with which some equity investors spoke to us last week about why they think the Fed will cut a few times this year was the polar opposite of comments we heard back in February and March, where investors expressed certainty that the Fed would definitely not be able to cut this year because the economy was just too strong and inflation was just too sticky. Last week, it felt like we were all the way back in January again, where there was rampant optimism. Another pendulum that swung in a way that doesn't quite sit right with us is investor sentiment generally. AAII net bulls came in at more than 17% last week for the second week in a row. And that's not too far from levels that are one standard deviation above the long-term average, around 20-21%, which were also in place to start the year. Moving to the political realm, we've also been keeping a close eye on a chart we highlighted a few weeks back showing how U.S.-Europe performance within equities has been tracking the Trump-Biden spread in betting markets. We've suspected this is because many non-U.S. investors have perceived Trump winning as negative for Europe from a foreign policy perspective. We'll continue to track this chart closely to see if the relationship endures, but for now we note that the recent bounce back in U.S. equities has coincided with some modest gains by Trump, not only in betting markets but in the national polls and a few swing state polls as well. And finally, to wrap up, we note that whatever was pressuring U.S. funds flows recently seems to have resolved. Outflows from U.S. money market funds, both retail and institutional, as well as U.S. equity funds, have reversed course and have turned positive again per EPFR data. Within the U.S. equity category, the improvement has been driven by large cap equity funds, primarily passive. That's all for now. Thanks for listening. And please, if you're a fan of our work, don't forget to vote when those II ballots come out.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.